You get your paycheck on Friday. Before it hits your account, something already happened to it. Not a fee. Not a mistake. Not something you can call and fix. A percentage. A predetermined slice taken before the money was ever yours to spend. Federal tax, state tax, Social Security, Medicare. By the time the number lands in your checking account, it is already smaller than the number you earned. You accept this. Everyone accepts this. It is just how it works. Across town, a man made 40 times what you made this week. He paid a lower percentage than you did. Not a lower amount. A lower percentage. You paid 22% of what you earned to the federal government. He paid 15%. You worked harder this week than he did. You traded hours for dollars the way you always have. He did not trade anything. His money made money while he slept, and the government charged him less for it. This is not an accident. This is not corruption. This is not a secret. It is written in plain language in a document anyone can read. Nobody told you to read it. This is how the rich pay less tax than you. Chapter 1. The two tax systems, running simultaneously. You have one relationship with the tax code. You earn money by working. The government takes a percentage before you see it. The percentage gets higher as you earn more. This is called a progressive tax system, and it is the only system most people ever experience. The rich have a different relationship with the tax code. They earn money from owning things, from investments, from assets that generate income without requiring their time, and the government taxes that income at a completely different and significantly lower rate. There are not two tax systems in America. There is one tax code. But inside that one tax code, there are two completely different sets of rules depending on how your income is generated. Rule set 1 applies to earned income, wages, salaries, bonuses, the money you get for showing up and doing work. This income is taxed at ordinary income rates. In 2026, those rates go from 10% at the lowest incomes to 37% at the highest. Rule set 2 applies to investment income, capital gains, qualified dividends, the money generated by owning assets that grow and pay out. This income is taxed at preferential rates. 0% for lower earners, 15% for most investors, 20% for the highest earners. The same dollar earned from working and the same dollar earned from owning are taxed at completely different rates. A surgeon earning $400,000 a year in salary pays a marginal federal rate of 35% on her income above a certain threshold. An investor earning $400,000 a year in long-term capital gains pays 20%. Same amount. Different source. $60,000 difference in federal tax. The surgeon went to school for 12 years. She works 80-hour weeks. She saves lives. The investor owns assets. He checks his portfolio occasionally. The tax code does not care about effort. The tax code cares about the source of your income. That is the foundation of everything that follows. Chapter 2. The salary trap. You're 29. You just got promoted. Your salary went from $58,000 to $74,000. You're excited. You tell your family. You go out to celebrate. You sit down the following April to do your taxes. The raise pushed you into a higher tax bracket. Not all of your income is taxed at the higher rate, only the portion above the bracket threshold. But the effective rate on your total income crept upward. You also lost eligibility for certain deductions. The phase-out started quietly at your new income level. A student loan interest deduction disappeared. A retirement contribution credit reduced. Your raise was $16,000. Your actual take-home increase after taxes and lost deductions was $9,800. You are not imagining it. The salary system is designed so that earning more through work becomes progressively more expensive. This is not malicious. It is the structure of progressive taxation. The logic is that higher earners can afford to contribute more. But here is what the system does not advertise. The progressive tax structure applies almost exclusively to earned income. The moment your income shifts from salary to investment returns, the progression stops. A person earning $400,000 from capital gains does not pay 35% the way the surgeon does. They pay 20%, flat. The same rate applies whether they earn $400,000 or $40 million from investments. The salary earner faces a climbing rate as they earn more. The investor faces a capped rate no matter how much they earn. Your promotion pushed you into a higher bracket. Elon Musk's Tesla stock, appreciating by $10 billion, did not push him into a higher capital gains bracket. The bracket was already at the ceiling. You're climbing a progressive ladder. The wealthy are standing on a flat floor. Chapter 3. The Stepped-Up Basis Nobody mentions. You're 35. Your grandfather passes away. He leaves you his investment portfolio. He bought those shares decades ago for $50,000. They are now worth $800,000. The gain on those shares, $750,000, was never taxed. Your grandfather held them his entire life. He never sold. Capital gains tax only applies when you sell. By holding until death, he legally deferred $750,000 in gains for decades. But here is the part that surprises almost everyone. When you inherit the portfolio, your cost basis, the price the government considers you to have paid for the shares, is reset to the current market value, $800,000. Not $50,000, $800,000. This is called a stepped-up basis, and it means that if you sell the shares immediately after inheriting them, you owe zero capital gains tax on $750,000 of growth. The gain existed. It accumulated over decades. And then it disappeared at death without ever being taxed. Your grandfather's estate may owe estate tax if it exceeds the federal exemption, currently over $13 million per individual. Below that threshold, the entire stepped-up basis benefit is available to anyone who holds investments until death. This is not a loophole. This is not tax evasion. This is a feature of the tax code that has existed for decades and is available to any investor who holds assets long enough. The people who know about it plan around it. They hold appreciating assets instead of selling them. They borrow against the assets for living expenses. More on that shortly, and pass the stepped-up basis to their heirs. The people who do not know about it sell their investments, trigger the capital gains, and pay the tax. The code does not punish ignorance. It simply does not reward it. Chapter 4. Borrow, don't sell. You're 42. You need $200,000. Maybe for a business opportunity. Maybe for a real estate purchase. Maybe just for life. You have two options. Option 1. Sell investments. Trigger capital gains. Pay tax on the gain. Receive the after-tax proceeds. Option 2. Borrow against your investments. Use them as collateral for a loan. Receive the cash. Pay no tax because a loan is not income. The wealthy use option 2 almost exclusively. This strategy has a name in financial circles. Buy, borrow, die. It sounds cynical. It is accurate. Buy appreciating assets. Borrow against them for living expenses and opportunities. Die with the assets. Pass the stepped-up basis to heirs. Start the cycle again. At no point in that cycle is a capital gains tax bill triggered. The assets grow. The loans are serviced by the asset growth or by income from other sources. The tax bill never arrives because the taxable event, the sale, never happens. Elon Musk, Jeff Bezos, and Larry Ellison have collectively borrowed billions of dollars against their stock holdings. These loans are not taxable. The stocks continue to appreciate. The stepped-up basis waits at the end. You cannot do this at the same scale. But the strategy is available to anyone with appreciating assets and access to a securities-backed line of credit. Brokerage firms offer portfolio loans starting at relatively modest asset levels. The interest rates are often lower than mortgage rates because the collateral, publicly traded securities, is highly liquid. You do not need to be a billionaire to borrow against your investments instead of selling them. You need to know that the option exists. Chapter 5. The Depreciation Shield. You're 46. Your colleague Marcus just bought a rental property, a modest duplex. He rents both units. Combined rental income is $28,000 a year. You expect him to pay income tax on $28,000. He does not pay income tax on $28,000. The tax code allows real estate investors to deduct depreciation, the theoretical wear and tear on a building over time, against their rental income. The IRS assumes residential property depreciates over 27.5 years. Marcus's duplex was purchased for $380,000. Approximately $300,000 of that is the building value. The land does not depreciate. Divided over 27.5 years, Marcus can deduct $10,909 per year in depreciation. His rental income is $28,000. His depreciation deduction is $10,909. He also deducts mortgage interest, property taxes, insurance, and maintenance. Another $12,000. His taxable rental income is $28,000 minus $22,909 in deductions. He reports $5,091 in taxable rental income on a property generating $28,000 in actual cash. The depreciation deduction is particularly powerful because it is not a real expense. Marcus did not spend $10,909 this year on wear and tear. The building did not lose $10,909 in value. In most markets, it gained value. The deduction is theoretical, but it is real on his tax return. Real estate investors at scale use this to generate substantial income while reporting minimal taxable profit. The code encourages this because the government wants private capital flowing into housing. The incentive is intentional. Whether it is fair is a separate question. Whether you should understand it is not. Chapter 6. The Charitable Giving Strategy. You're 51. You have a stock position worth $500,000. You bought it years ago for $80,000. The gain is $420,000. You were planning to donate $100,000 to a charity you care about this year. Option 1. Sell $100,000 worth of stock. Pay capital gains tax on the proportional gain, approximately $84,000 in gains, roughly $12,600 in federal tax at 15%. Donate the after-tax proceeds of $87,400. Option 2. Donate the stock directly to the charity. When you donate appreciated stock directly, you receive a charitable deduction for the full current market value, $100,000. You pay zero capital gains tax on the $84,000 gain. The charity receives the full $100,000 and pays no tax because it is a nonprofit. Option 2 saves you $12,600 in capital gains tax. The charity receives $12,600 more. The government receives $12,600 less. The wealthy use donor-advised funds to execute this strategy at scale. A donor-advised fund is a charitable account you contribute assets to, receive an immediate tax deduction, and then distribute to charities over time at your own pace. You contribute $500,000 in appreciated stock to a donor-advised fund today. You receive a $500,000 charitable deduction today, potentially eliminating your entire taxable income for the year. The fund holds the assets, sells them tax-free, and you direct grants to your chosen charities over the next 10 years. You eliminated your tax bill this year. You supported causes you care about. You moved $500,000 of appreciated assets without triggering a capital gains bill. This is legal. This is available. This is what sophisticated tax planning looks like from the inside. Chapter 7. The Offshore. Question. You're 56. You have heard the word offshore. It sounds illegal. For most people at most income levels, it is irrelevant. But understanding it is important because it shapes how you think about the tax system as a whole. Large multinational corporations earn profits in multiple countries. Where those profits are taxed depends significantly on where the corporation claims to have earned them. Ireland has a corporate tax rate significantly lower than the United States. For years, major American technology companies structured their intellectual property ownership through Irish subsidiaries, meaning royalties from global software sales flowed through Ireland, where the tax rate was dramatically lower. This is not tax evasion. Tax evasion is illegal. This is tax avoidance. Legal, planned, executed by teams of lawyers and accountants whose entire job is minimizing the tax burden of their clients within the boundaries of the law. Apple paid a 3.7% effective corporate tax rate in 2021, according to its public filings. The U.S. statutory corporate rate is 21%. The gap between the statutory rate and the effective rate is filled entirely by legal strategies: depreciation, R&D credits, deferred income, offshore structures, loss carry-forwards. None of this is secret. It is all disclosed in public filings that anyone can read. The strategies are legal because corporations and their lobbyists have spent decades influencing the tax code to make them legal. The tax code is not a neutral document. It is a living record of every negotiation, compromise, and interest group that shaped it. Understanding this does not mean you agree with it. It means you stop being surprised by it. And when you stop being surprised, you start asking the more useful question: what parts of this system can I legally use myself? Chapter 8. What you can actually do. You're 31. You're not a billionaire. You do not have offshore subsidiaries. You do not have a donor-advised fund, or a securities-backed line of credit, or a stepped-up basis strategy. But you have more options than you think. The first thing you can do is shift income from earned to investment as quickly as possible. Max your 401k. Max your IRA. If you have access to an HSA, max that too. Every dollar that goes into these accounts reduces your taxable earned income today and grows at preferential rates inside the account. The second thing you can do is hold investments longer than 1 year. The difference between short-term and long-term capital gains rates is the difference between your ordinary income rate and 15%. On $10,000 in gains, that difference could be $700 or more every year, permanently. The third thing you can do is harvest losses strategically. When an investment loses value, selling it crystallizes that loss. That loss offsets gains elsewhere in your portfolio. Up to $3,000 in losses per year can offset ordinary income directly. The rest carry forward to future years. The fourth thing you can do is own real estate. Even a single rental property gives you access to depreciation deductions that can shelter significant rental income from taxation. The fifth thing you can do is understand the tax implications of every financial decision before you make it. Not after. Before. The difference between selling an investment at 11 months and 13 months can be thousands of dollars in a single transaction. None of these strategies require wealth to execute. They require knowledge. The wealthy do not pay less tax because they found a secret door. They pay less tax because they learned where the doors were and walked through them. The doors are in the same building you are already in. You just did not know they existed. You get your paycheck on Friday. Before it hits your account, a percentage is already gone. You still accept this, but now you understand it differently. The man across town who made 40 times what you made and paid a lower percentage, he did not cheat. He did not bribe anyone. He did not find a secret system unavailable to everyone else. He learned where the doors were. The tax code is not written against you. It is written around behaviors the government wants to encourage: investing, holding assets, building businesses, owning property, giving to charity. Every tax advantage available to the wealthy is attached to one of those behaviors. The gap between what you pay and what they pay is not a gap in fairness. It is a gap in knowledge. And knowledge, unlike a stepped-up basis or a securities-backed loan or a donor-advised fund, costs nothing to acquire. You already started.